same link we're using the old link. Link सब डाला. Hello everyone, my name is Hitesh and I would like to take this opportunity to welcome you all to Elevate 21. Elevate is a 5-day event starting from today and it will go till 31st of August. During these 5 days, there will be 5 quiz events and 10 keynote speaking sessions. So you'll get a lot of learning and a chance to win big. There will be a lot to learn from our speakers because they have a wealth of industry experience and they are influencers in their own way in the field of trading, investment and finance. And I almost forgot to mention, there's a cash prize of more than rupees 1 lakh to be won. So sit back, enjoy, and make a lot of winning in the form of cash. Now I'll take this podium to welcome our first speaker. Our first speaker for the day needs no introduction. He is well-known personality in the world of business and finance. He's a chartered accountant and cost accountant by profession, and he has got more than 3 decades of industry experience. He has been part of various business conglomerates like the Hindustan Unilever, ITC, and Reliance Money, to name a few. He's the current chairman of Inditrade Group, and I'm honored to present to you Sudip Bandyopadhyay. He's our first keynote speaker for Elevate 21, and he will be talking about best opportunities for investment in the current market scenario. I take this podium to welcome you, sir, and I leave the podium for you now, sir.
Thank you, Hitesh. I hope I'm audible.
Yes, sir, you are audible, sir.
We have been watching the Indian markets. I have been personally watching the Indian markets for more than 3 decades. 1991 onwards, we have started our journey of reform and development with a renewed vigor. Always the question have been everybody's mind, promise versus performance. While India undoubtedly promises a whole lot of things with its vast land area, significantly large population, the potential definitely is significant. The question is how much of this potential or promise can we or are we realizing? And that's where the financial market, stock market investors needs to focus on. While the journey of our reforms, journey of our capital market progress have been patchy and have been almost satisfactory. It's nothing extraordinary. We are always like to remain self-critical, but it has been something which could have been better. That's what I think most of us feel. That's what most analysts across the world feel. India has the potential to do much, much better compared to what it has been doing or it is doing currently. What changed the world in the last 1.5 years, almost 2 years now, is the pandemic COVID 2019. I think COVID and related or some unrelated geopolitical issues brought a significant opportunity in front of India. I won't say it wouldn't have come. I would rather say that it accelerated the realization or crystallization of the opportunity within a very, very short span of time. I would broadly talk about 2 areas of opportunity. One is the China factor. The other is the digital transformation journey. I think the China factor has been talked about, is being talked about, and will continue to remain talked about. One is China plus one. The other is China minus. So what does China minus mean? All of us know. Avoid China and work with other democratic, other positive potential bases. That's the clarion call which the global investors, global manufacturers, global organizations are giving. The second is a call for China plus. Companies, industries, investors who were totally focused on China, dependent on China, are looking at creating a strategy whereby they have an alternate base. So that's China plus one. So they will not move away lock, stock, barrel from China. They will not completely exit China, but they will develop a parallel base or an equal if not bigger opportunity in some other pockets of the world, which can substitute China or which will complement China. Now, India definitely benefits in a big, big way from both China minus as well as China plus one. Indian organization, Indian entities, Indian companies are benefiting and should benefit at a much, much larger scale as we go forward in the years. We have already seen the same getting played out in some of the sectors, specialty chemicals, pharma, chemicals, which are direct beneficiaries of China plus one and China minus. I think we have the potential of seizing this opportunity once for all and become a large, large manufacturing base catering to the world. Look, what had happened in India over the last 20 years, India has definitely emerged as a powerhouse as far as soft power is concerned, as far as technology is concerned. But manufacturing, we were way, way behind. Forget China, even many other Asian peers. This is probably a great opportunity for India to seize the initiative and move. The government of India has taken lots and lots of initiatives in the recent past to steer the economy, provide appropriate benefits so that Indian manufacturing in the appropriate sectors does get a big leg up and can start competing with the world. Whether it's a tax structure, which is now amongst the best in the world for the new companies, manufacturing companies, and even startups, or for that matter, the PLI schemes and other multiple initiatives does actually translate into significant attractiveness for Indian manufacturing for not only Indian but the global companies. The second factor which is happening is the substitution of China, and that can play a significant role. I talked about pharma, I talked about chemicals, specialty chemical. In these areas, it's already happening. People are substituting China or adding India to the China for their sourcing base. These two things will go hand in hand, and we believe, along with the congenial climate the government of India is creating, this can take India to a great height. Now, this is not only a philosophical or stock market driven. This also is a need of the economy for the hour, and that indirectly again benefits the growth of the economy, the growth of the country, and the stock markets. The India story was incomplete without inclusive growth, and inclusive growth required in a country like India, which has got a very large population, soon going to be the largest population in the world, to absorb the workforce on a continuous basis. There probably can no better, at least in the medium to short term, option but manufacturing to a big role in absorbing this workforce, gainfully employ them, and use the demographic dividend productively. So India needs manufacturing. India needs to seize the China plus one, China minus opportunity and move forward. We as investors need to seize this opportunity as well.
Right, sir.
The second trend which I will talk about is digital transformation. I think COVID has accelerated this digital transformation in an unprecedented way. While we were all were aware that artificial intelligence, machine learning, digitization is the order of the day, none of us anticipated the pace at which digitization took all of us, made all of us surprised. What COVID created was unprecedented. Indian software companies, Indian automation, Indian industrial engineering companies have got a big, big leg up post COVID-19 hitting the world. The order books of software companies swelling. They've never ever seen this kind of order book growth. They've never ever seen this kind of a demand. The demand not only for new products, digitization, artificial learning, machine learning, but also consolidation of vendors, which is helping Indian manufacturers, Indian industry, Indian technology companies. So we have to seize this opportunity as well as investors. Now, the pandemic has also brought another angle to the entire market debate. And that debate is around how the government can incentivize, government can kickstart the growth process. And this obviously requires a significant amount of public spending. The government is talking about it, government is actively pursuing measures which enables it to do public spending. We all are aware of the constraints as far as finance is concerned of the government of India, and they are trying all the tricks in their book to raise money so that they can deploy the same for significant public spending to initiate the virtuous cycle of more and more spending by public sector initially and then private sector so that the economy gets a leg up. Now, having said all this, what is also happening on the market, on the ground, there are two things which are happening. One, which we saw that central banks across the world, including India, pursued a loose monetary policy, which created significant liquidity. Now, this, on one hand, ensured that FPIs brought in a lot of money to India. On the other hand, and I think that's a bigger advantage, domestic investors, domestic HNIs and retail got very, very active. They brought in a lot of money. We all know what happened as far as number of accounts in the broking space, number of demat accounts, that actually exploded. And this is getting reflected in the volumes which is being hit by the markets on a regular basis over the last 1.5 years. The markets have touched all-time highs, and now, in spite of FPI selling periodically, markets are holding its ground, and that's thanks to retail, thanks to domestic investors. This is an excellent trend. We in the early 2000s, mid 2000s, used to actually the first decade of the current century, we used to always think that when Indian retail will have the enough muscle to withstand an FII selling. And that's happening today as we speak. Also, the number of IPOs which are hitting the market and getting subscribed, oversubscribed, is something which we should all enjoy, and we should thank our stars for that. I'm not talking about the evaluation, whether they are justified, not justified, but the sheer fact that the new issues, IPOs which are hitting the market, are getting subscribed handsomely by and large, is it something to cheer. What happens? This ensures that the depth of the market increases significantly. So the supply of money in the market and depth of the market both are increasing, and this augurs well for Indian capital markets. Quickly coming back to the sectors, quickly coming back to what we think is good for the market, good for investors. I talked about the China plus China minus sectors, which are specialty chemicals, pharma, chemicals, and some other manufacturing niche areas, which will benefit from this substitution of China or addition along with China as manufacturing is concerned. We have seen this getting played out, and we will continue to see this getting played out over the next decade. That's what we believe. As far as digital transformation, we have seen Indian IT getting re-rated, and we believe this re-rating process is just in its nascent phase. This re-rating will continue for the next probably 5 years. As far as government spending is concerned, we believe the beneficiaries will be infrastructure, construction, cement, building materials, and this is real. Housing for all, infrastructure spend on roads, ports, and other things by government will definitely kickstart a very, very virtuous cycle as far as these spaces are concerned. I must also talk about what fuels all these sectoral growths. That's money. And if it's money, BFSI definitely has to and will play a role. Yes, banks and financial institutions were reeling under asset quality challenges, but believe me, I think we have probably seen the worst, and things are going to improve. So whether it's the leading private sector and public sector banks, whether it's the insurance companies, the gold loan companies, the NBFCs, I think they will play a good part and good role in priming the economy. We believe that there is enough valuation gaps in these spaces for investors to beneficially own and invest in these sectors. Apart from all this, FMCG is one which, yes, it's available at a higher valuation, but these are evergreen sectors. Indian consumption is increasing, and even now, if you pitch Indian consumption vis-a-vis consumptions in some of the other Asian countries, I think we are way behind in many parameters, and that provides us an insight into how these things will grow over a period of 5 to 10 years. So, Indian FMCG, Indian consumer durables are the stocks to look forward to. They will go a long way, and FMCG and consumer durables should also not be neglected for an investor's long-term portfolio.
So, before we
Overall,
move on, so I have got like a lot of questions from our viewers.
sure,
I
we
would
can
like
go.
to ask a couple of questions, sir. So the first question which I got, like, which other country can capitalize on China minus policy? Does India have any competition in that sector? Like countries which should look out for, sir, for a long period of time, sir.
Well, I think some of our smaller Asian neighbors are doing very well. Vietnam has people say have already steamed a march over India. There are a lot of manufacturing shifting to Vietnam. It continues to be a low cost base, even much lower compared to India, and that definitely has an attraction. We also believe that Bangladesh has been doing very well. Their GDP is growing very well. Economy is booming. Per capita income of Bangladesh has increased and crossed Indian per capita income. So I think some of the neighbors are trying to seize the opportunities. But remember, they are smaller. Their capacity to provide China plus or China minus is limited. So, whereas India has a real potential to be a substitute for Chinese manufacturing and Chinese markets. Also, remember some of these companies who set up bases, they look at the domestic market. Now, in Vietnam or in Bangladesh has a very small domestic market. Indian domestic market is really very large, and this also is a big attraction for some of these guys who are looking at China minus and China plus.
Right, sir. So another questions which I got is like I mean, our viewers are asking that you seem to suggest in a way that maybe it's time to move from traditional investment sources like the banking shares, maybe to more modern like software, chemicals, and other pharma. Are you hinting towards that also, sir?
Well, what I believe firmly, Hitesh, is that one should have a balanced portfolio. You should stick to. I talked about BFSI. I believe in BFSI. I believe, why I believe. I think that's the simple arithmetic. If the GDP has to grow, let's say at 10%, I think BFSI has to be at least double the rate. Then only the GDP can grow. Always banking and financial will move ahead of the GDP growth numbers, and that's going to play. And if that is the case, then the leading banking financial stocks, I'm a firm believer in Indian insurance industry. That's got a huge road to traverse and move ahead. So I think these are the sectors which investors should not neglect. They should have BFSI in the portfolio, good quality stocks. They should have the emerging sectors or the China plus China minus type of sectors, and also a mix of technology in their investment portfolio.
Right, sir. And sir, we got another question on the IPO. Like people want to know actually that is what is the logic behind investing in a certain company? Is it just what's the current sentiment of the market right now, or do you look at other factors if you have to look for IPO investing? How do you shortlist a company I should be going for investment or not? What's the rationale? How to choose it?
Is it talking about IPO or stocks in general?
So first IPO and stocks because I've got questions on both sides. That was my second question.
Let me start with the stocks. I think I think more relevant. For me, the stocks, first thing I look at is the quality of management. And this is, a lot of my colleagues in the industry may differ on this, but I believe the quality of management and their track record is of paramount importance. If we buy we want to buy a pet, we look at the pedigree of that. What is that pedigree of that dog or that cat or that pet we want to buy. So similarly, I think there is no substitute for the quality of management. If you have a good quality management in a company where you are a shareholder, you can rest assured ups and downs may be there, but in the long run you will benefit, you will win. But if the quality of management in a company is bad, if the trustees of the shareholders is not trustworthy, then you have a big problem in hand. The second thing which I will say is the valuation. You may buy a very good stock, excellent quality management at a very high valuation. Now, I'm not saying disaster will happen, but your appreciation, the kind of returns you will expect from that level will be probably limited. So you need to always look at the valuation at which buying the stock. Now, valuation depends on not only the absolute or abstract number, but look at what the growth potential of that industry is, and what the performance of the company has been, and what the performance and potential of that company vis-a-vis that industry is. So growth and valuation. Valuation is always linked to the growth potential. So look at the growth potential and the valuation before investing in a stock.
Right. So that
As
actually
far as is concerned, let me complete the IPO part, Hitesh. I think the IPO is an interesting, very interesting space. Most investors look at, or most market participants look at quick entry and exit. While if you're doing that, then I will like you to focus on completely on the market sentiment and what are the kind of subscription numbers you are looking at on the day 1, day 2, and day 3 initially before deciding. But if you are looking at investing, I think what you need to look at is the valuation at which the IPO is coming. Now, normally there are comparable domestic companies, comparable international examples. Look at that and look at the valuation at which the stock is coming. Of course, you need to look at the management quality and what I talked about. That is general, that is standard. You should always do that before investing in a stock. But the valuation definitely deserves a very, very keen look, because that's what is going to make or break. Because a lot of companies in the recent past, we have seen them come at a full valuation where there is very little left on the table for the investors, because probably the valuation at which they are asking the shareholders to subscribe, the investors to subscribe, is a futuristic valuation. Now, whether you want to subscribe at a futuristic valuation, to me the answer is no. You wait for the company to achieve something, then you can give them a premium, but not before they have achieved certain things.
Right. So that's actually very interesting, because personally, if I also do the same thing, if I were to go for short-term gains, I look at what is the mood of the market right now. I mean, to be fair, similar thing we did for Zomato IPO also, because it was more sentiment driven. And another question which I've got is like slightly off radar, but it's a very interesting one, that our viewer is asking, are FDs a thing of past? Do they still have a role in balancing one's portfolio? And are there any alternatives to FD investment in the market? When FD, I mean fixed deposits.
I understand. Well, I think investing in FD can never and will never go out of fashion. I think at a certain age and certain income profile, FD you cannot do away with. When you need safety, when your regular income is not there, you need a certain amount of safety, and there is no substitute to FD there. But if you are little willing to take a bit of a risk, slightly bit of a risk, I would recommend REITs, real estate investment trusts, and investment trusts which are coming now in the market and will continue to come in the near future. These are modern, recent instruments. A REIT invests in commercial real estate, and 90% of the income of the REIT is distributed on a yearly basis. At least 90% needs to be distributed. So you get a certain regular income, and also you have a potential for upside on the real estate the REIT is holding, commercial real estate the REIT is holding. So it's got a blend of fixed income, regular income, as well as an upside potential. By and large, they are safe. I would still recommend do the diligence on management quality and the properties the REIT is holding. Same thing for investment trusts. Look at the concept is same between REIT and investment trust. They will give their regular income out as dividend, and there will always be an appreciation possibility based on the underlying assets going up. So though a little complicated for the traditional and older generation, I think for younger generation, some amount of fund in instead of FD in REIT can REIT or investment trust can work wonders. Of course, rest will depend on your risk appetite. Liquid mutual fund has a substitute for FD, but I think the return, right now at least, the way the returns are poised, you don't get much of a difference. FD gives you a little more comfort, little more safety, little more ease of operating. Unfortunately, mutual fund has its own challenges. So while liquid mutual fund works for large investors, for small investors, it may not work.
Okay, makes sense, sir, because I mean, a lot of people are still in the thing that FDs are a thing, but there are a lot of other alternatives which can be safer and give a decent amount of returns, right? So another question which I've got is like from a young investor, is saying any advice and how does one tackle the bull run and how do you know that when should I invest, when should I not invest in the market, or I mean, what's your take on that, sir?
Well, I think timing the market is a very, very complicated thing. I don't think anybody has ever successfully and consistently. People may say I've successfully done it. Probably they're just lucky. You can't do that consistently. Timing the market is impossible. My recommendation always has been, like most professionals in my field, is that stay in the market time. Pick up a good stock, stay in the market for a time. I'll give you an example. Let's say you want to buy SBI Life. I'm just giving an example. It's a fantastic stock. I believe it's a good stock. Now it's around 1200. Will you get overnight appreciation? Will it go to 2000 in 15 days, 1 month? I don't know. Nobody knows. And should not probably. But if you're willing to spend time in that stock, I think definitely it will give you significant appreciation. Is it the right time to buy tomorrow morning? I don't know. Maybe there will be some correction. It can come to 1100 in some days. But if you're determined to be in the market for 1 year or 2 years or more, it doesn't matter whether you buy at 1150 or 1200. If you're able to buy at 1100, 1150, you are lucky. Your timing has been right. If you buy at 1200, it's fine, because end of the day, you're investing there for a year. By the time it has probably gone to 1500, 1600, God knows what. So you have made your money. So my point is, you buy some good quality stock, you will probably never get it cheap. There is never a right time. Some people say when the company has declared bad results or something like that, but will you wait eternally for a company to declare bad results? They may never declare. So I think if you're liking a stock, if all the other parameters are met, go and buy it. But remember, this is a long-term investment strategy. If you're a day trader, if you're a momentum buyer, then the advice will be completely different.
Right. I mean, actually, if you were to remember about a year and a half back, a fake story about whistleblower Infosys came, and the share prices tanked massively. But look at where it's trading right now. So yeah, maybe picking the quality stock makes a lot of difference. So just one last question, sir, which has come up by one of our viewers. He's saying that what's your take on crypto market, and do you think is it become a new form of investment strategy?
Well, being from a slightly older generation, I am still trying to understand really honestly what crypto can and can't do.
Right, sir.
People bet on multiple things. We bet on race horses. We bet on a whole lot of other. So surely you can bet on something if you have that appetite. But as an investment, I'm not sure. Look, I think the fundamental problem here is it's a currency. By definition, you're talking, it's a cryptocurrency. Now, currency doesn't get legitimacy unless the central banks and the governments of the country support it. Unfortunately, as things stand today, 99% of the governments and central banks are against this. There are valid reasons. A lot of mischief, a lot of money laundering, a lot of unfortunate activities can be carried out by using these pseudo currencies. So I think till that acceptability comes, till it gets certain kind of acceptability, it won't be safe definitely. Somebody may make some money at some point of time by investing and exiting, but I definitely won't recommend.
Right, sir. So those were the questions from our viewers, sir. What would you actually want to conclude this by giving us some tips about your investing or trading style to our viewers? As in, what should be the mantra for them, sir?
Well, my suggestion to all my investor friends will be: believe in India, believe in Indian markets. I think there is nothing fundamentally wrong. Look, markets are at all-time high, near all-time highs. There may be some correction here and there, But if you believe in the India growth story, if you believe in Indian GDP growth story, and the potential of India, you can't go wrong. We have seen this multiple times. Infosys, you gave an example, it had corrected. We had seen it in last March, April 20, May 21, 20. The markets had tanked where the markets were. From there, it has bounced back. And I have seen this getting played out in multiple periods when the markets had tanked, but it has bounced back. The sheer strength of the economy, the potential of the economy pulls and propels the market. Somebody may say FIIs invest. Of course, they are investing and they will invest. Look, their mandate is to generate returns. And India is one place which still gives them a return which is better than most other developed and developing markets. So FIIs, FPIs will come, domestic investors will invest. Where will they go? FD, as some of you asked, definitely is not the answer. Many other asset classes, are not the answer. So equity will attract money. Equity should attract money. Believe in equity, invest in equity. I talked about some of these sectors. Pick up the leaders or top few companies in these sectors, invest, wait for a year and a half. You can't be a loser. You will definitely beat all other asset class returns, if not, much better than that.
Right, sir. I mean, it has been a really, really informative session for me, sir. I mean, I would like to thank this opportunity again. Thank you for coming on our podium, sir, and giving us a chance to listen to you, sir.
Thank you.
Any
Thank you.
words of advice for the end? And I mean, I'm really, really glad to be able to hear you, sir.
Thank you.
Thank you so much for coming, sir. And I wish all our viewers, I hope you had good time. And we'll continue with our next session. It starts at 3 p.m. So I would want you to log in straight away for that. Thank you so much. Thank you so much, sir.